Hey guys, it's Max Convexity. I'm sitting here next to my little dog Jax, and you've tuned into the Max and Jax After Dark show, or Late Night with Max and Jax, or I don't know what it's called. I have to decide on a name pretty soon. Thanks for tuning in. I'm dead ass tired tonight. I think this is the 7th video I've made, so I'm going to try not to make this too long of a video. Per usual, Jax has gone and found the nearest toy to chew on to try to disrupt the broadcast, but he's a dog. He doesn't know any better. But yeah, I'm dog ass tired. I'm going to probably cut this one short tonight, or short as I can. I have a bunch of questions I'd like to answer, though. I had a lot of really good videos today, and so I got a lot of good questions. My buddy in Discord, Echo Eversky, I think he put this chart in Discord, or he put another chart similar in Discord. He's talking about the yield curve, and I don't know near as much about it as he does, or as a lot of people do. I'm not a macro analyst, but and maybe I can get him on some night and he can give us his take on it. But I like this chart. They show this chart every time we're about to go into recession. So the bottom chart is the yield curve being inverted. And that's when I don't know, it depends on it's the 2 years and 10 years, or, yeah, it's the 10-year over there's different definitions. This one happens to be the 10-year T-bond minus the 3-month T-bill. So on this chart, it's inverted whenever that relationship is negative. So the interesting thing I always thought about this chart was that the recession hasn't even started when the yield curve's at its worst. The recession actually starts, if you look at the top chart, lots of times interest rates have started going back down by the time the actual recession starts. Look what happened in 2008, 2009. Interest rates peaked it looks like maybe a year before, well, maybe not that much, but sometime before. And the yield curve bottomed out several months, or heck, it's hard to tell. I need to get a better chart, but a good period of time before the actual recession happened. So what does that mean for next year? Well, it means maybe we'll have one next year, or maybe it won't be till the next year after that, or who knows? Look at this little one in 2019. We had a recession that lasted 1 month. Maybe we'll hit one of those again. That was December of 2019, I believe. Who knows? But as the yield curve uninverts and interest rates start coming back down, and that's what everyone's talking about next year, saying that they have 3 or 4 or 5 interest rate cuts priced into the Fed funds futures. So, maybe that's what they're anticipating. They're anticipating that, and so maybe that's bad news for next year for the economy. Like I say, maybe we can get Echo Eversky on to give us, or some kind of macro person to give us a different take, or a better take. I tend to be a little bit too bullish. I bet Echo Eversky could dive a little bit deeper into that, and it probably wouldn't be quite as rosy as my scenario, because usually the thing is, by the time the recession happens, lots of time the market's already recovering too. So as far as the market goes, I'm not worried, but I'm rarely ever worried. And I'm not really a perma bull, but the market goes up way more than it goes down, and way more often than it goes down. And it doesn't mean it won't go down or it can't go down, but it just doesn't pay to be a perma bear, in my opinion. But I am obsessed with tail risk hedging, and that brings me to my video today. It wasn't one of my better ones, but I thought it was all right. But what I wanted to say is I'm getting ready to start a series. It was a viewer comment. I'm getting ready to start a series on tail risk hedging, and not buying ETFs, on doing it yourself. That'll probably start after the first of the new year. But I'm also going to talk about asset allocation, and being defensive, and allocating your assets in a defensive manner, and trying to lock out inflation, and also trying to lock out volatility from your portfolio. I have a really good video planned for right after the first of the year that's going to cover a lot of that stuff, and I'm excited about it. So that's kind of why I did this tail risk one today. This was just kind of to get us started. But I really do like that QTR, and I didn't mention it in the video, but XTR is the same thing. XTR is based on the SPX, and QTR is based on the NASDAQ. I like them a bunch. And heck, let's look over here at this darn chart. I didn't even go into it, but Swan was also a good looking one. I mean, I liked them all except CYA. And I'm sure there's nothing wrong with CYA. Just that deep out of the money stuff just isn't for me. I just love the 10% out of the money like QTR and XTR does. So you can monetize, smaller declines. So let's see what else. Let me answer some questions. Hey, the good news is I've already done the math for the profit boxes, so you don't have to sit through that again. I will go ahead and draw them in front of everybody, but that shouldn't take 5 minutes, and that'll be at the end of the program. But there's no sitting there and having to watch me do math and then forget lots of times I forget what number I was supposed to remember when I'm flipping back and forth between the spreadsheet and the web. Anyway, so I'm trying to get this over early. The problem is I have a lot of good questions. This first one right here was a great question. It's more like a comment. I need to ask this guy a couple of questions. Maybe he's worked at an ETF before in the industry, but he says when creation units are made, they print shares and sell them on the open market until the fund price goes back down to its NAV, so no premium. Yes, that dilutes earnings, but what happens to the cash they pocketed from printing the new shares and selling them? Shouldn't that counterbalance the dilution? And I have no idea. I mean, hopefully I have a viewer that knows. I would think that I would think somebody has to get paid. Sure, they can print shares, but you can't print money. At some point, whoever printed the shares is going to be short money or something. I mean, the money I would think would go to the fund managers, and that's what they pay the dividends with, right? I mean, am I overthinking it or underthinking it? I don't know. Hopefully someone will help me out on that. I try not to read the ones where people agree with me. I mean, I'm not trying to butter myself up. Some of these are too long to answer or I don't have time, so it's easier just to talk about them. Let's see if we have some other good ones here. This guy makes a good point. He says, I think people should be happy with IWMY on December 1st, ex-dividend date. IWMY was 21 bucks. The last dividend was $1.25 per share. Today, as of today, it's recovered to 21.07. That's pretty good, isn't it? Yeah, and it is. And it is. IWMY has been awesome. I mean, it's the NAV's not dragging too bad. I mean, it's been awesome. All right, let's see. I had some other questions I wanted to get to. All right. I get this question all the time. At what point is this going to be a problem and the advantage goes away? Once this catches on with the larger market, will the whole concept implode? And I don't think so, but maybe there's something I'm not seeing. These options they're selling are super liquid, and I would think these funds could grow a lot more before they start affecting the options. I mean, maybe at some point, if everyone wants to do this, there won't be enough options available to sell. But on the other hand, there's market makers that'll, I'm sure, will be happy to make a market and then hedge the risk away. I don't see, I don't see that. But I get that question all the time and similar questions. If somebody has an opinion, leave that in the comments or help me out on that one. I don't know. I don't see that. This person, KJK Good, said, I wonder if equilibrium can be reached when assets under management is fully invested, then more return dollars come back alongside share dilution. And yes, I think we've already seen that happen to QQQY, and I think their assets under management have already stabilized. That fund was really popular the first month. I wasn't following it, but I bet you it experienced some share price dilution. But like I explained to one commenter, I'm not sure this is actually correct, but I said, the small funds in a fund that's first starting out is going to be more susceptible to dilution because it's easier, in theory, for a fund to go from 3 million assets under management to 6 million assets under management than it is from 3 billion assets under management to 6 billion. Although theoretically, I don't know if that's true. I mean, The math is the same, but still, there's just not as much money in the world. It takes more raw dollars. Even if the percentage is the same, it takes more raw dollars. So I do think that's a good theory. And I mentioned it somewhere else, but these people that say, hey, I'm going to wait 2 or 3 months and see what these funds do. Maybe, I've never heard someone say because I'm scared of dilution. Most people just want to make sure they're pay. I don't know. Most people just want to see how they do, and I get that. But this may be another good reason, in addition to just seeing how they do, to not have to go through the heartache of seeing your profits get diluted. That's my theory on it. It feels like I'm screaming, but I keep getting comments that the volume's not loud enough, so I'm trying to speak loud. I hope it sounds loud. Whenever I cut a long video together, like I did today, where I'm on camera, I edit it, and when I go to post-production, I boost it 5 decibels and do some other stuff to it to try to make it better. So, but I think even on that video, I'm pretty sure I even got a low volume comment on that video. So I don't know, but I am working on it. Here's somebody that corrected my math, the same person, and I kept saying it was 2.5 times growth in shares, but I kept saying a fraction was 2.5, and it was really 3.5. Okay, here's another question I wanted to talk about. Okay, this guy says, helpful, but I didn't know this. So assets under management must be rising alongside the share count, yes? Yeah, that's true. This does harm the argument of investing here. Isn't the same for yield max. Maybe I misunderstood, but I think they're saying that yield max would be better, but if he's saying, is it the same with yield max? Yes, I would think a yield max fund could have this same problem happen to it. Especially if it's first been introduced and everyone's piling into it. I wonder why this hasn't happened with Coney yet. Seems like everyone and their dog owns Coney. I think Jax bought some Coney. I don't know, but I saw him on his freaking Tasty Trade account the other day. All right. Well, I made kind of a smart-ass comment, and I said it'd be nice if we could just make it where people could just invest at the first of the month so we didn't have to worry about dilution, or not smart-ass, but it's unrealistic. That's not the way the world works, and we wouldn't want to take the hit in liquidity. But the person made the point that makes no sense to limit inflows of investment capital. Correct. That would be anti-capitalistic, and yes, I'm not for that. I was just kind of speaking out of my ass, so to speak. This is a good question. This person said, why are they diluting? And I just said, because a lot of people bought the shares this month. There were 7 times as many shares at the end of the month as there were at the start of the month. I don't know if that's what he's asking, but I don't think they are doing anything. There's no they that are diluting it. It's we, the people that are buying it. Yeah, and here's somebody that corrected my math, and I really appreciate this. I have a problem where when I'm on camera, I can usually do math on the fly in my head pretty well, but when I'm on camera, my brain stops working. Anyway, I'll try to get better, but yes, thank you. I appreciate that. And here, Alan is one of my favorite commenters. He said the audio is fine, but I have another favorite commenter that said it was still low, so I'm working on it. All right, guys, let's try to do some other stuff. Let's see what else is going on. I'm not trying to keep you guys up too late. If you want, maybe we could do this as a live stream soon. Maybe tomorrow night or maybe soon. I mean, I think that might be fun. All right, we've already talked about that tab. This is a back test I ran that I didn't talk about in my video today because there wasn't time. I can't believe that video was 20 minutes long. Oh my gosh. I didn't seem like I talked that long. But this was back testing, buying 6-month out of the money puts and just rolling them every 6 months. And you can see it expires almost every time worthless. There was a couple of times in 2008, 2009, and in 2020 they cashed some bets in, but it's just that's way out of the money. I didn't know you could do this with the back test. I hadn't seen the tab where it said download the spreadsheet. This back test wasn't very interesting to me, but now that I know I can download the spreadsheet and analyze it different ways, I'm going to do some back tests that are more particular to what Defiance is doing with the in-the-money puts. And then we're going to look back at history and see how it would have done had Defiance been around, in 2020 or in 2015 or whatever. And we could look at 2017 whenever vol was real compressed. I'm always saying, that's going to be a problem when vol gets compressed. Anyway, that's a good idea for another video, but I was proud of myself for figuring that out. It says down here at the bottom, export results. I just hadn't seen that yet, but makes all the difference. All right, so there's the profit boxes. I don't know if we're ready for the profit boxes yet. All right, I have a couple more comments that I wanted to mention. I guess this one. We'll do this one. This top one's kind of a hard one. Okay, before we do that, I have a question for you guys. I'm new to YouTube. Should I block these people that talk about stuff that's a non sequitur to whatever I'm talking about? I mean, crypto's the best future where people makes money and generate good return. Is this a bot or something? Because then I never answer those because, hell, I don't know. I'm not trying to teach you how to make money. I'm just trying to prove these funds don't decay and trying to help people to understand how options work and that kind of stuff. I mean, heck, but then they always, these things always go and they always recommend somebody's name. And then they always say they're on Telegram. And they always have a name like Mrs., something that just doesn't even sound like they're speaking English as a first language or something. Maybe I should block those. I guess that's people spamming my timeline, or not my timeline, my comments. I mean, maybe I should take it as a compliment if my channel's getting big enough to attract spam. Yeah, and here's one of my favorite commenters also. This person is a great commenter, and he's saying the audio is kind of low. But he was talking about the end of day update. Okay, so I think it was good on my last big video. On these end of day updates, I need to remember to speak up. All right. There's somebody else that corrected my math. Or, well, no, that's the same comment we read a second ago. All right, so let's do this one last comment. Let's look at the profit boxes, and I'm going to let you guys go to bed. I'm going to watch football with Jax, but it looks like the game's going to be over. I'm watching Oklahoma State play Texas A&M right now. It's 31-20 in the third quarter. The game's basically over now. Texas A&M just isn't very good. I'm not a big Texas A&M fan, but I'm not a big Oklahoma State fan either, so I just kind of have it on in the background. All right, let's talk about this one a little bit. Hey there, Max, and thanks for all your info and hard work tracking these funds. Much appreciated. Apologies if already asked an answer, but can you comment on two things? Your perspective on how this fund manager goes about choosing where to set the strikes each day. Arm style, quarterback style. Does current P&L in the month matter? How is realized and expected volatility incorporated, for example? Okay, so this is a guess, but it's based on, hours or probably an hour of interviews I've seen with Jay Pestruccelli, the fund manager. And it's also based on what I've heard other YouTubers say and publicly available information. But no, these guys, they sell the same option every day. It doesn't matter what the market's doing. Sometimes they take it off early if they can, but basically they just let it run till the end of the next day and let it expire. This is what I would call an automated, or it's not automated, but it's an I want to say algorithmic, but it's a mathematical trading strategy. Their edge that they have built in comes, in my opinion, from their back test. They know that the option they sell, and it's a 65 delta put, which is in the money, but I think they have back tests that support, that they can pay such and such dividend. And so, no, I don't think they adjust it as volatility goes up and down. I don't think, but we'll have to see. I'll darn sure, keep track of that and let you know. I do know there's funds out there that do that. Spy Eye will actually sells call spreads most of the time, but if volatility gets really low, like it did in 2017, they'll turn around and they'll buy call spreads. So So yes, there are funds out there that use different techniques that will look at the level of volatility and adjust the distance at the strike price and uh, different things. But I don't think this is one of them. I could be wrong. Okay, max downside risk. In a black swan event, worst case, is this a wipeout? For my basic math, anything more than about a 1% decline here is going to be very painful. And then a series of days like that, I guess it's about probability and some kind of reversion to the mean, which is correct. I guess this goes to position sizing, but it seems like a challenging strategy when there's a sustained drawdown. And yeah, for sure. And I'm gonna do the next video I'm gonna do, the next big video I will do is where I'll do the back test and download the spreadsheet, and we'll look back at how this fund would have done, how this strategy would have done. The fund wasn't around. We'll look back at how this strategy would have done in other challenging market environments like 2009, and then we'll look at 2022 was not a great market environment. I mean, it was a slow grind down, but then we'll look at 2020. 2020 is a pretty good, black swan type, or pretty good, what I'm trying to say, stress test. February and March of 2020 was a pretty good stress test. I will say that it didn't wipe out any of the other funds that are doing the same types of strategies. And I've answered this question before, but he's probably, or him or her, probably a new subscriber. So I'm happy to do it again. In my opinion, what it's going to take this fund down is a 50% drop in one day and then another 50% drop in the next day. And yes, that would probably end it. You'd have so many redemptions. Maybe after the first day you would. If you get a 50% drop over 10 days, which is kind of what he's saying 1%, 1%. No, these, because of the way the volatility resets every day, because they sell a daily put, and as the market's dropping like that, the volatility is rising big time. And so you're selling that put every day and getting more and more volatility as it goes down. Yes, it would not be a great situation for the NAV, and it would take the fund, a long time to recover. But we can look at QYLD and XYLD, how they did during COVID. They, they're similar type funds. They do calls instead of puts, but it took them forever to recover. I don't think one of them has recovered yet. So, the tracking error and the problem on these things is more on the upside, not on the downside. But no, a couple of one-day declines isn't going to be fun. We had a 1.5% decline the other day and it knocked out 3 days worth of profits. If we would have had 3 of those days back to back, it would have knocked out a whole month's worth of profits. But then whenever it did revert to the mean and started going back up again, the volatility would reset. The puts would be paying more than they were before, and you'd be fine. But it'd be painful. But that's trading. That's anything. Another point I want to make about these funds, this is the same thing it's essentially the same thing as going out and buying the shares of the stock. All they do is take the assets under management and they sell the equivalent number of puts to equal 100%. If they just went out, let's say there's $10 million under management. One guy could go out and buy $10 million of NASDAQ stocks. And another guy could go sell $10 million of, or forget about this, $10 million of NASDAQ stocks. Let's say that was 1,000 shares, okay? So options are in units of 100. So another guy could go out and sell 10, at the money put contracts. The 10 put contracts are the same thing as 1,000 shares. If the market drops 50%, the guy with 1,000 shares is going to be down 50%. The guy with 10 put contracts is going to be down about 49% because he captured some premium from the puts when he sold them. So it's the same thing as buying stock. A lot of people think it's leveraged or just think because the options are naked, and they are naked. But so when you buy stock, that's naked because it can go to zero, just like an option can. I mean, it's the same thing. You could look at an option profit calculator and you can punch in, however many. Okay, look at this. We could go punch in. This is the NDX. They sold 165 contracts today. I think that's anyway. They sold 165 contracts. You could go to an option profit thing, and you could do 165 contracts at that strike, and the amount that you would need in your account to facilitate that trade would be 276,800 or 276,800,000 or within pretty darn close to that. All they do is they figure out how big their fund is, and that changes every day, and they go out and sell the equivalent number of puts. When you're buying a put, it's a bearish strategy. When you're selling a put, it's a bullish strategy. So if they sell, however many puts equals that much, they're essentially the equivalent of being long the equivalent amount of stock in the index. There's no leverage. There's no extra risk above just the regular QQQs. Like I say, the QQQs will be down a little bit more because these things capture premium every day. So, but it's virtually the same risk. And that's a very common question, and I'm happy to answer that. I hope I did a good job. Leave a comment if there's a better way to put it than I put it. I didn't want to say the word notional and start talking about the notional value, but I'm just too tired to deal with it tonight. Let's talk about these profit boxes, and let you guys get out of here, and I'll watch the rest of this football game. Okay, first of all, thank you to I got a lot of good commenters. I'm trying to think who gave me a tip on this. His name's Alan, and he said, "Hey, which one was it? One of these." Yes, it was IWMY. On IWMY, he said, "Hey, just heads up, they sold options that don't expire tomorrow. They expire Friday." And I really appreciated that. He was absolutely right. They do expire Friday. Anyway, I think he's seen me do my spreadsheets, and occasionally I miss details. I appreciate him bringing that to my attention. So hopefully this spreadsheet is perfect tonight. Thank you, Alan, very much. All right, let's do this profit box real quick. So these guys sold 456 contracts, put contracts at the 2080 level for 16 bucks. So let's go over here. Of course, IWMY trades Russell. I'm going to have to make this box twice as long this way, longitudinally, because the day is going to be equivalent of 2 days. So anyway, 2780. So I'll show you how I do it. All right, 2780. Usually the profit boxes are about that big because that's how long a day is. Well, if it's going to go 2 days, we're going to run it out to here. Jackson, please quit crying. I'm going to be done in just a second, okay, buddy? He doesn't understand who I'm talking to, I don't think, and it confuses him. So it was 16. So now the total cost of the option was 16 bucks and change. So I need to subtract 16 from 2080, or I could just look over here at the break-even price, 2063.28. All right. All right, so that's our profit box for the next 2 days on the Russell, on the IWMY. Let's go over here and look at the JEPY. Let's see if I did. I'm already thinking, yeah, this one has a situation, but I'm going to work through it. It looks like they sold it looks like they did not go in the money. It looks like they sold an option that was out of the money because I have negative intrinsic. Anyway, I'll check the figures on that, but I'm gonna draw the profit box 4780. See, this is, gosh darn it, look at this. I will check the numbers on this, and if it's wrong, we'll look in the morning update. But they did not get a whole lot of premium for this darn option. $5.37. I mean, they were getting 10, 12, 16, 29. Now, this depends on how far it is out of the money and stuff, and this one's closer to the money, so that's why. Or anyway, but all right, I'm just gonna draw the profit box, and then, like I say, I'll come on with the correction tomorrow. Yeah, it looks like they wrote an option that was out of the money instead of in the money like they usually do. So there's no intrinsic, it's all extrinsic. So, and that's why it wasn't very much, I guess. I don't know. I don't think I'm saying that right. I've been working, I've been at this too long today. Don't hold me responsible for anything I said. I'll listen to this podcast myself and I'll probably make some corrections. All right, so there's the profit box for SPX. Like I say, we're gonna take that one with a grain of salt. QQQY. Oh, I do want to say thank you to Alan also. Alan, or I think it was on one of these stocks. Which one was it? Yes, IWMY had two different tranches of stock. They had some 2065 puts. They had some 2070 puts. When I gave my end of day update, one of them was 3 points in the money. So I went ahead and figured out I took off 3 points. But it turns out, and Alan also pointed this out to me, the fund managers closed it out for zero somehow. At least that's what their spreadsheet says. Now, I'm not trying to argue with Alan, but how the heck did they do that? Or I'm not trying to be disagreeable, but I don't see a point in time they could have sold that out for zero. I mean, maybe when it was right up here, but, you know, maybe when it was above the profit box and they closed it out early, but heck, that was like 2 or 3 hours before it closed. I would think it would have some time premium in it still at that point. So I don't know how they did that. Or maybe it was on this other profit box. That's what it was. It was on the first profit box. Yeah, I don't know. Anyway, let me know if you guys have ideas. Anyway, profit's profit, and we will definitely take it. Thank you, Alan, for pointing that out and making sure I didn't miss that. All right, so what do we got here? So let's see. We need to look at the. All right, so let's do the NDX, and then, like I say, I'm going to let you guys get out of here. I'm going to take Jax for a walk and watch the rest of this football game. This is the Aggies versus the Aggies. Texas A&M is the Aggies, and Oklahoma State's the Aggies. Both agricultural schools a long time ago, or they're probably still they are. But all right, so what do we got to do here? QQQY. Okay, they sold 165 at 16,919 for $33. So, all right. Wait a second. What the heck was that? 16,919? I didn't think they did every number. I thought it was 15 and 20s. I thought that would, anyway. Let's look real quick. Let's see what the heck's going on. 1691. Yeah, so I transposed the number. My bad. 1691. That should make a difference in some of my calculations. All right. I'm going to check one more time because there's still something that doesn't seem right. All right, they bought the options back today for zero. That's what the slash mark means in the top line. And yeah, they sold the same option except for the next day, the 28th. All right, I guess that's right. Easy peasy. Well, I'm going to sleep good tonight. Physical work makes you tired, but for me, working on the computer or talking all day makes me tired. I used to be in sales. I was a stockbroker. And when I gave presentations and we went on the road to sell something and I talked all day, I was exhausted at the end of the day. It's good work. It's good work. It's a first world problem to be exhausted from talking, for sure. All right, let's just get this show on the road. This is another one that looks like it has just virtually no intrinsic. See, that's the thing about intrinsic and extrinsic, and I've griped about this before. We don't know exactly when they sell the option. So just to take the close, if they sold it 30 minutes before the close, the intrinsic is right here. You know, and I bet that's what they did. They're not going to sell something for no intrinsic. I mean, you know, that's why I take the intrinsic and extrinsic numbers with a big grain of salt. 910. So let's check out the break even real quick. So 910 less 33/16 a break even. So 876. So we'll call that 877. So I need a line going from 877. And maybe they didn't sell it there because that doesn't look like enough extrinsic now. I bet they sold it right about when the market was about there. It's just a wild ass guess though. So, we'll see. The good news is about calculating the distributions. I don't think the intrinsic and extrinsic played a part directly. Indirectly they do, of course, but it looks like the cheat code to figuring it out is just taking the profit earned and dividing it by the shares. So we'll try that next month and see how that works. All right, guys, just to remind you, it's not financial advice. I don't say that often enough, and I don't feel like I'm giving advice. I more just talk about how I feel about stuff. But occasionally I do give advice, and I don't mean to, and I'm not trying to, and I'm certainly not trying to tell anyone what to do. Everyone should check with their own financial planner. I'll be anxious to see in the comments, and I hope some of you stick around and talk to me. And I'll be anxious to read the comments and see what you liked and what you didn't like, and we'll go from there. And I will talk to you tomorrow. You guys have a wonderful evening. Oh, one thing, I forgot to do this last night too. Let's check futures. Let's check stock index futures, okay? These trade all day, even though the NDX, SPX, and RUT just trade during market hours. So look, here we are. We're up again. We're up 20 bips in the NASDAQ. We're up 15 bips in the S&P. And we're up 0.25% in the Russell. So anyway, that's nothing. I mean, who knows? Anything could happen by the morning. I'll be back on around 8:30 and we'll see where we're at. And I'll check that funny number on that JEPY and make sure that's correct. Hey, thank you very much. You guys have a great evening.